Well, welcome back to our series on preserving founders' equity. My name is Steve Perry and I'm the founder of Scarab Ray. In part one of the series, we went over the traditional way of financing your business, venture capital. We talked about some of the challenges and opportunities that go with the use of a preferred share that has real control and valuation challenges in terms of funding your business. We have to say that this is really the golden era of venture capital. These extraordinary firms are changing the world around us every day, and it's really quite remarkable what they're accomplishing. At the same time, it's also the golden era of startups. There's some great research been done out there by people like Mark Suster, who've pointed out that the cost of an internet startup has gone from something like $5 million in 2000 to, I believe it's down around $5,000 in 2012. That's a remarkable change. Again, change on a Moore's Law scale. And that's an opportunity for you as a founder to preserve your equity. And it would say that there must be some sort of a conflict with venture. If venture rounds are in fact getting bigger as the cost of getting a company off the ground is getting smaller. You as a founder need to really think carefully about that part of the curve. So in part two of the series, we introduced the idea of the Canadian open source financing ecosystem. Now I've had some comments that's a bit of a mouthful, so we're going to turn this into an acronym. We're going to call it a Cosy Financing, Canadian open source ecosystem for financing. Well, a Cosy Financing is really nothing more than a disaggregation of the value chain. I had one investor up here say to me a number of years ago, Steve, I don't do retail, I invest wholesale, meaning investors in Canada typically don't want an intermediate third party, as we will see in a closed source financing in the venture capital world, that's putting their money in place and is charging a fee for it. That's part of the advantage that goes to you as a founder when you use common share equity as part of your financing structure. So that was part two of the series. In part three, we're going to have two halves to this presentation. The first will be about the journey you're going to go on as you finance your business. And the second will be about how to use Cosy Financing as an alternative financing approach. All right, this Venn diagram pretty much summarizes how I look at startups. We're all a mix of the three spheres on that Venn diagram. Our ability to sell, the creation of value on the balance sheet that's something intrinsically worth money to an investor, and finally our ability to manage cash. When you start out with an early stage business, there's pretty much no way you're not selling what I refer to as vision-based selling. So you're basically selling your shares in the company based on the future value that you perceive and that you're presenting to your shareholders. Nothing wrong with this. This is how you have to start out, as you really don't have a proof point yet. And those early investors make a bet on you and how you're doing that. But at some point, for all of us, there's going to be this conversion to have to demonstrate numbers to be able to show a positive curve in terms of profitability. And that transition means you're going to move down towards the third sphere on my Venn diagram. That can be a very painful experience. First of all, you're dealing with a different investor base that likes that results-based sale. And second, you're going to see challenges to valuation as you go through that, unless you're on a hockey stick ride to unicorn status. That's an important piece of the puzzle that you have to sort of assess when you do that. But there's an opportunity here. And if we can find that overlap between the three spheres, between our ability to sell, our value, and our ability to manage cash, we can make use of what's known as the Rule of 40. What is the Rule of 40? This is an old financial analyst's metric, and it's pretty simple. You add together your growth percent to your EBITDA percent. And if that number is better than 40, it puts you in a rarefied atmosphere of really extraordinary companies with, frankly, extraordinary valuations. Brad Feld really popularized this for SaaS businesses in 2015 when he started to talk about this as a relevant metric. There's been additional work that has said you could convert this into simply a balance between burn rate and growth. I believe it was Fred Wilson that made the observation that's the same thing as $1 of burn should generate you $5 of new revenue. I prefer to work with that original analyst version where you're basically looking at a combination of growth and profitability as a measure of your business. It's a very different way to look at a startup. If you get there, if you can start to drive your business towards a Rule of 40 outcome, you have the ability to place yourself in that same group of companies with high multiples. So here's a plot of what's known as the Bessemer Nasdaq Cloud Index. This is an index of effectively SaaS businesses plotted on their revenue multiple against their Rule of 40 performance. You can see it's a pretty correlated group of companies. On this graph, the yellow dots I've actually added to the index entries, and I've done that to provide some information on the very leftmost part of the curve. These are the smaller businesses, sub $1 billion. And what you'll see from this is that this is basically a polynomial distribution, and that for companies that sort of get into that 20 to 40 Rule of 40 number, they start to see really significant value increase. Remember, a value increase or a multiple increase from just a 1x revenue multiple to 2x, that's a doubling of the market cap of your business. So you can see the value this has. I believe that because we have this extraordinary opportunity to drive companies to profitability sooner, we can get on this curve at a much lower revenue rate than originally perceived in the marketplace. And that's one of the core concepts behind how Scare Bray looks at your business. We want to see you get to the profitability point much earlier in the cycle, and to use that as a means of increasing value and preserving your equity. Right, so let's move on to the second half of the presentation and talk about how to actually do that. Here's what we would say is a really effective way of financing your business. To us, you have to start with bootstrapping. You have to get that business up and running on your own nickel. And that doesn't necessarily mean it has to be cash, as we've talked about. Sweat equity and the extraordinary low cost of running companies can get you there at a very, very low cash burn rate. If you do that, then there are common share investors in the Canadian marketplace who will be very interested in funding your business. That early common share equity preserves your control of your enterprise and usually gets you a valuation level that is going to be quite attractive in the marketplace. You may have to give up some warrants as part of that calculation, but the ability to continue to be the manager of the business, to continue on with your control of your business, we can't really overstate. Having done that step, now we start looking at what is termed non-dilutive capital. This includes things like government grants, royalties, and in some cases, forms of unsecured convertible notes that convert into a future round valuation. The real key here is to hold valuation, not give up equity for this important and critical middle part of your fundraising cycle. A little bit about the royalty structure. Again, that's mostly what I've been involved in recent years. The royalty is based on the idea that you pay a monthly royalty fee based on the revenue of your business. It goes up and down with your revenue. And at the end of the day, you're going to pay out somewhere between 1.5 and 2.5 times the original investment. It's a way of getting a venture capital return for an investor without you having to give up the extraordinary upside if you're highly successful, and this is a big 10x plus multiple exit. So that's the middle part of the curve. If you've gone through the exercise of getting to a positive Rule of 40 number, now you're in a really remarkable position. You have the ability to manage your company on your own cash flow, or should you choose to access the Canadian public markets, the TSXV and the CSE, both public venture capital markets with investors that understand you're still a growth business, but that invest in permanent equity where there is no 10-year fund life that will compromise your ability to run the business going forward. Or, having achieved profitability, you also have the ability to simply continue running your business. That's a choice you get to make. And by using this multi-step process up in Canada, you've avoided the control characteristics and that upcoming 10-year fund life decision in a venture capital financing round. We believe this is an extraordinary way to finance your business. We think it has real merits in terms of maintaining your control, and it's what we would recommend to you if you decide to have a conversation with us at Scare Bray about advice on how to finance the business going forward. Well, that wraps up our three-part series. I'm really excited by the opportunities that are available to startups today to use these kinds of structures to finance the business, effectively and efficiently and maintain control. I'd love to have a conversation. Once again, here's my email address and our company website. We'd love to talk to you, and good luck with financing your company.